So what we want to do now is more or less like a continuation of the main CVPA course, where we looked at CVPA proper and we solved questions on CVPA. Now, if you look at what we did earlier, we defined what CVPA is. We define what CVPA is. Although you may not see a question in your ICAN, you may not see a question that will tell you to define CVPA, but I'm sure that you will see a question that will tell you to state the assumptions of CVPA. And I'm still sure that you will see a question that will tell you to define the following terms: contribution, contribution to sales ratio, in fact, even including break even. So I explained these terminologies and I gave you the formula that is used to compute for contribution, contribution to sales ratio, and also for contribution. Then I went further to explain the concept of break-even analysis, where I said it's a point where a company does not make profits and they do not make loss. And I told you that break-even can be divided into two. We have the one in units and we have the one in naira or in value. So the formula is fixed cost divided by contribution per unit. Then for the value owned is fixed cost divided by contribution margin ratio. So I'm explaining this again because we are going to look into it as we continue today's aspect of CVPA. So the only difference between the both formulas is that the one of units usually makes use of contribution per unit. Okay, CM, contribution per unit, or we call it contribution margin per unit. Okay, but the one for BEP, the one for naira or in value will make use of contribution margin ratio per unit. So don't confuse it. Contribution margin per unit for units. Then the one for ratio will be contribution margin ratio. Okay, contribution margin ratio. All right, so we look at the concept of margin of safety. Okay, how safe a company, the organization can be when it comes to making loss within that organization. So if you say we are breaking even at 1,000, okay, so margin of safety talks about how safe can we be, how much, what less of quantity are we going to produce for us to start making loss. That's what we use margin of safety to determine. So what is the quantity of product that we are going to produce, okay, from the point that we are now before we start making loss? It's as simple as that. Okay, then I told that the formula is simply budgeted sales minus break-even amount in sales. So this is more or less like a revision. The margin of safety is in naira and it's also in units. It's also in units. You will see question on this. So I went down to tell you that there's something known as margin of safety ratio, where we have margin of safety in units divided by margin of safety, budgeted sales in units. So this margin of safety is what you have computed here earlier, which is budgeted sales minus break-even sales, or budgeted unit minus break-even in units. That's what you have here as the numerator. That's what you have here as the numerator. What the denominator is the budgeted revenue and the budgeted what? Sales in units. So I also told you that you can also see questions where you'll be asked to calculate the volume, which is the units to earn a target profit. This one is without tax. I told you that there's a scenario where they will tell you that with tax, okay, that is after tax. Okay, we're going to look at something like that today again. Then target revenue, this one is in units. Target volume in unit, this one is target revenue in naira. So the same thing, total fixed cost plus target profit all over contribution per unit. Then total fixed cost plus target profit, this one will have a contribution to sales ratio or CM ratio. Okay, CMR. It's as simple as that. So this is the overview of CVPA. Now today I want to go a little bit deeper. Now what I want to do is that I will solve this illustration 4. This illustration 4 is a normal CVPA question, which we have been solving before. But I just want to repeat a question on it to give us more understanding. After solving illustration 4, I will move to what do you call it? There's one here, application of CVP analysis to non-manufacturing organizations. Okay, to non-manufacturing decisions. It means that what about companies that are into trading? Okay, what about companies that are into trading? What about companies that are into service rendering? All right, so how do you apply CVPA to them? We are going to look at that. Then we're also going to look at the last part of it, which is more or less like the main reason for today's class, which is known as multi-product break-even analysis, where a company has more than one product. How do you compute the CVPA for it? Everything I'm going to look at today is going to be very, very simple. It's very, very simple. So let's just commence right now. Let's commence. Now, let's see. So let's take this illustration 4. Now, what we want to look here is that the requirement 1 states, calculate the break-even point in units and in sales value. That's the first requirement. And we remember that the formula for break-even point in unit is what? We say fixed cost over what? Contribution per unit. Okay? While the break-even point in sales will now be what? Fixed cost over what? CM ratio. That's the first thing that you need to do when you see a question like this. You can, once you're able to put down the formula, then you can now start extracting what you need. Now, let's read the question and see how we can solve this. It said that the following are the information taken from the production plan of Adebola Manufacturing Company Limited for 2012. Now, relating to the manufacture and sale of honey soap. Okay, planned level of production and sales is 120,000 in unit. So what you plan to produce and what you plan to sell is 120,000 units. Then the selling price is about 20 naira per unit. Then variable cost is broken down into material and labor, which we have 8 and 7 naira. Then the next is apportioned fixed overhead, which is 2 naira. So apportioned fixed overhead means shared overhead. So we incurred overhead, for example, 1 million, but we have shared it to all the products. We say, okay, per product is going to take 2 naira. So this is 2 naira per product. Okay, so for us to get our total fixed cost, all we just need to do is to say 2 naira multiplied by 120,000 naira. I hope that makes sense. Okay, so we now have planned profit for the year. So our selling price minus our variable cost and fixed cost will now give us our profits. Okay, so we are now asked to calculate the break-even point in units and sales value. So we'll pick the first one, which is fixed cost divided by contribution per unit. How do we get fixed cost? As I've said earlier, our fixed overhead cost is 2 naira per unit. So we'll say 2 naira multiplied by 120,000. That should give us 240,000, which is this working one, 240,000. Please, anywhere you are not clear, you can let me know. Then the denominator is what? Contribution per unit. So what you just need to do is to look at the question and pick out just the variable cost, because the formula for contribution is saying sales minus variable cost. We have sales minus variable cost. Our sales is clear, which is 2 naira, but our variable cost is 8 naira and 7 naira. Okay, 8 naira and 7 naira. This one here is fixed. All right, it's fixed. So we're going to say 8 plus 7. I think that is 15. The 20 minus 15 is actually 5. So I think that is what they did here, working 2. So that is it, working 2. Okay, that's working 2. So we are solving for break-even points in units. So once you divide 240,000 divided by 5, that gives us 48,000 in units. So this is the quantity that should be produced if the organization intends to break even. All right, if the organization intends to break even, that is, they don't make profit and they will not make loss. That's the quantity. Then the next is break-even point in naira. Okay, break-even point in naira. So remember the formula: fixed cost divided by contribution margin ratio. CMR is same thing as CS ratio, Abi. Contribution to sales ratio. Yeah, I told that the formula is simply contribution divided by what? Sales. That's the formula. So our fixed cost will remain the same. We still have 240,000 here. Then our CML ratio, which is what? C, contribution divided by sales. What's our contribution? Don't forget that we have done contribution here before, which is 5. Okay, which is 5. Which is 8 plus 7 is 15. Okay, 15. Then 20, which is this sales minus 15, is what gave us 5 as our contribution. So our contribution has been done for us. We've solved our contribution, which is actually 5. So how do we do it? What's our sales again? Contribution is 5 and our sales is 20. So please, if you do 5 divided by 20, you must get 0.25. Okay, that's how to get your CM ratio, which we have done in our previous videos. So 5, which is contribution, divided by sales, which is 20, you get 0.25. So when you divide, our BEP in naira is actually 960,000 naira. That means that if we sell 48,000 units, we are going to get 960,000 naira. 960,000 naira as revenue. Okay, as revenue. In that instance, we are not making profit and we are not making loss. Okay, good. I hope you are following, please. Then the next one is II, which states that the amount of profit if sales is reduced to 100,000 units. Now, you will see things like this in ICAN exam. In fact, this is an ICAN adapted question. Question we are solving now is an ICAN adapted question. So what am I trying to say? They said the amount of profit, calculate profit, okay? If sales is reduced to 100,000 units. Sales was initially 120,000 units. So if you want to get this profit, this is profit you want to calculate. So the amount of profit if sales is reduced to 100,000 units, it's very simple. Just say selling price per unit, which is 20 naira, multiply by 100,000 naira, 100,000 units. Okay, multiply by 100,000 units. That's what they did here. Let's see. Okay, let's see what they did. Good, this is it here. Income statement at 100,000 units, which is the sales to determine sales. Okay, to determine sales at 100,000 units. All these ones were the workings that we did. Then contribution per unit, which is 5. Then contribution margin ratio, which is 0.25. Now, we need to prepare our income statement if we want to determine profitability. So we know that our selling price is 20 naira, but our quantity has changed from 120,000 to 100,000 units. So if you multiply, you have 2 million. Okay. What about our variable cost? Our variable cost is 8 and 7. It's in the question, 8 and 7. Look at it here, 8 and 7 for material and labor, 8 and 7. All right. So all you just need to do is to bring it out and multiply it by 100,000. Okay, 100,000. That's how we got 800,000, 700,000. And if you add both together, you get to 1.5 million. So sales minus variable cost gives us total contribution. Total contribution. All right. Then we have fixed cost. Our fixed cost is 240,000. We have solved that before. Where we said 120,000 times 2. Now, the reason why we will not do 2 times the new 100,000 is because fixed cost does not change. So that is where students are going to get it wrong. Some students are going to say 100,000 unit times these 2 to get their fixed cost. That will be totally wrong. So even if the quantity you are producing or selling is changing, okay, fixed cost will not change within a range of activity, except if you are otherwise told in the question. So we'll still maintain 120,000 times 2, which is what, 240,000 in our solution as our fixed cost. And that is how we got this 240,000. So 500 minus 240 gives us a profit of how much? 260,000. I hope this makes sense. I hope this makes sense, please. So that's 260,000. Then, what were we told again to do in the question? Here we were told again to do. Let's go back to the question. We'll solve for I. We'll solve for I now. So let's solve for I now said that the company has now received information from market research, which suggests that price and demand for honey soap are related as follows. So initially, we had just one price of 20 naira, and we had demand of 120,000 units. But now, market research is saying that forget, you may have different prices and different quantity demanded. Now, if we have a price that if we sell at 16 naira, people that are going to demand for our product is 180,000. Look at it, 180,000 quantity. If we increase the price to 18 naira, the demand for our product will drop to 150. If we further increase the price to 20, it will drop to 120. If we increase it to 22, it drops to 90. If we increase to 24, it drops to 60. This is normal economics. Now, you are now asking, calculate whether Adebola Manufacturing Company Limited has chosen the optimum level of production for the year and advise the management on production for the year and the related price that should be charged. Now, I will read that again for more clarity. He said, calculate whether Adebola Manufacturing Company Limited has chosen the optimum level of production. What is the optimum level of production? Okay, this 120,000, that was what they planned. Okay, that was their planned level of production and sales, 120,000. So we want to know if the company should produce this 120,000, which is this part here, and sell at 20 naira, which is this 20 naira here. Or should they produce 150 and sell at 18, or 180 and sell at what, 16? The only way we can know if this 120 that they have chosen is good for them is to prepare a profit statement that shows everything here in this in this table, everything here, and choose the one that gives us the highest profits. So we are trying to say we are going to prepare a profit and loss account now for all this selling price and their demands, and we'll see the one that gives us the highest profit. If we see the one that gives us the highest profit that is higher than this one that we get under 2120, or the one that is higher than the one that we got under 100, this 100 here, that means this one that we have chosen is not optimal. And let me make it a little bit easier. The company is saying that what they should produce is 120,000. But the researchers have gone to the market and said, sir, if we produce 180, we can sell at 16. If we produce 60, we can sell at 64. Don't you think we should produce 60 and sell at 24 naira? Well, I think we'll make a much more profit than when we are producing too much and sell at 20 naira. That's what we're trying to determine. So should we keep producing 120,000 and sell at 20, or there's any other price range here and quantity that will give us a higher profitability than producing 120 and selling at 20 naira? That is what we want to do. So what we just need to do is to take these figures, Control-C them, okay, Control-Z, that is copy, and come and paste them here. So this is more or less like a profit and loss account, but in a tabular form, okay, profit and loss account in a tabular form. So what we need to do is to put selling price, all right, and their variable cost per unit. Now calm down. This selling price is what we picked from the table. This is it. Selling price 16, 18, 20, 22, 24. Okay, that's what we did. So we'll come here 16, 18, 20, 22, 24. Now, if no matter what you are producing, you have to incur variable cost. So your variable cost is 15 naira. How do we know? You refer to the first one that we saw. Variable cost is 15 naira. 8 plus 7 is variable cost. So every other information is the same thing. Whatever that is changing is just the prices that we have that are numerous now, and the different quantities that we have now that is given to us. But our variable cost, fixed cost remains the same. That's just the rule. So 8 plus 7 is 15. So that is how we got this 15 naira that we put on all of them. Okay. Now, selling price minus variable cost, we are looking at this contribution. That's how we got all this contribution. So 16 minus 15 is 1. 18 minus 15 is 3. Now that we got contribution, we can now multiply it by the quantity to get total contribution. This quantity now, the quantity that we want to sell, 180, 150, 120, 90, 60. It's in the table. Okay, 180, 150, 120, 90, 60 is in the table. So just multiply and you get total contribution. When you get total contribution, you only need to remove total fixed costs. And remember that our total fixed cost does not change. It is 120,000 units, okay, from inception, multiplied by 2. So it is now 240. So that's what we got, 240 here. So if you say total contribution minus total fixed cost, that is how we get our total profit. Whatever we have done here is the same thing that we did here. But this one is in tabular, but there are many prices. So if you look at its sales, which is selling price, this is it. You see this less total variable cost, which is material and labor. This is it here, variable cost. You see this contribution, this total contribution, we need to get contribution per unit first and multiply it by quantity to get total contribution. So this is the total contribution. Then this less fixed cost of 240,000. This is the fixed cost here, 240,000 fixed cost. Then these are the profits. Okay, these are the profits. Now let us analyze. Let us analyze. If the company produces 180,000 quantity and sell at 16 naira, they are going to make a loss of 60 naira. This is in brackets. But if they sell at 18 naira and only produce 150,000, they will make a profit of 210. If you go back again to 20 naira and sell, quantity is 120, their profit will increase to 360. If we go back again to 22 naira and what we have 90 quantity, their profit will increase to 390. But the moment they move to 24 naira and sell 60 units, their profit will drop again towards 300. So these are the various prices, quantities, and their profitability if the company intends to produce them. Now, decision. Based on the analysis above, it is obvious that 100,000 units will not represent the optimal level of activity. What is that 100,000 units? This one that we calculated here. Okay, you know, I was telling you that based on the question, we produce 120,000 and we sold at 20. But when we calculated for II, we calculated at 100. And 100, the profitability for 100 is actually 260. Okay, that's what we made 260. Okay, now we are not testing for different prices. We are not giving our decision that this 100 that we produce and made 260. There are other quantities that we can produce that will give us above 260. Imagine, if we produce 120, we'll get 360. If we produce 90, we'll get 390. So I think the optimum here is actually produce 90 and sell at what, 22 naira. Let's confirm. This is because the associated profit at 100,000 units will be 260,000. Whereas the activity of 90,000 units and a selling price of 22 naira, the associated profit will be 390. So the optimum price that the company should charge, optimum selling price, and the optimum quantity that they can produce is actually 90,000 for quantity and 22 naira for selling price to give us a profit of 390,000. I don't know if this is clear. I don't know if this is very clear. So that is how we are able to compute for the requirements III, which states calculate whether Adebola Manufacturing Company Limited has chosen the optimal level of production. What is the optimal level of production? If we did not calculate for this 100,000, the optimal level of production would have been this 120,000. But since we calculated for 100,000 naira as we calculated profitability for 100,000 naira, so we are benchmarking our result in III as against I. Okay, as against I. All right. So please, is this clear? We have looked at BEP in units, BEP in naira, and we have looked at income statements when quantity changed. When quantity changed, everything will change, but your fixed cost will never change, 240. Then we'll look at a scenario where you are giving different prices and different quantities. Your fixed cost will still not change. Okay? Thank you very much. Let's proceed. Let's proceed. Now, what we want to look at is application of CVP to non-manufacturing decision. Now, let us assume that the company that we are working for is a service organization. Okay, it's a service organization. This is going to be quite different from how you account for it using for the manufacturing company, although it is the same CVP, the same formula. Okay, the same formula. But you just need to be conversant with the way the organization, which is the service organization, structure their activities. So let's take an example and see what we are looking at. If you look at this, you see that the Yavatech Medical Limited budget for year 2012 are stated below. In bed, this is an hospital. So number of beds available in that hospital is 80 per day. Okay, so they have 80 beds available per day. Inpatient days is 226,000 per annum. Patients that come into the hospital. Okay, then 6,000 per annum. Then inpatient fees, the fees that we charge patients is 1.3 million. So let me interpret this 1.3 million is like our sales. That is why this is a service company. So you must be able to identify their sales or revenue. Okay. Then cost, variable, fixed, total. We have direct supplies, direct salaries, patient service overhead, administration. These are our total variable costs. They've broken it down for us already. And these are our total fixed costs. And these are our total costs. Now you are now asked, you are required to calculate the contribution margin ratio. So CMR. What is the formula for contribution margin ratio? Contribution margin ratio is the same as what? Contribution to sales. So we need to look for contribution per unit and divide it by what? Sales per unit. So let's solve. What's our contribution? Our contribution is 1.3. Okay, in total. Okay, 1.3. What's our variable cost? 1,066,000. Divided by what's our contribution again? What's our sales again? 1.3 million. Now let me explain this. This one is like saying sales minus variable cost, which is equal to contribution. So this one is not saying contribution divided by what? This total figure is not saying sales. That's the meaning. So what we are technically looking at in this formula is contribution divided by sales. Okay. So since they give us figures in total, I would have divided to get figures per unit, but it's going to give me a little bit issue because I need to be dividing by quantity if it's units, okay, or by number of beds to get per bed. But since they give me in total, let me just make life easy for myself and work in total. Okay, let's work in total first for this one. So 1.3 is our sales, as seen in the question, 1.3 million. The variable cost is actually 1,066,000 total. Then our sales again is 1.3 million. If you solve this thing, you're going to get 0.18 or 18%. Yes, you're going to get 0.18 or 18%. Then let's move to the next one, which says the break-even point in both inpatient days and inpatient. So this inpatient days is like in units. So break-even point in unit, because that's the unit of measurement. Okay, so the hospital measures their income via the number of patient that comes in and the number of beds that they take, something like that. So this inpatient days is the break-even point in unit for manufacturing company. Then inpatient fee is break-even point in value. If you can understand this, it's very simple. So let's commence. So break-even point in unit, which is known as inpatient days, which is this, is simply total fees cost divided by contribution per unit or contribution per inpatient days, any how you want to put it. Okay, contribution per inpatient day. So what's our total fees cost? That one is not hiding. 252,000. This is it. It's not hiding. 252,000. Then what is our contribution per unit? Okay, what is our contribution per unit? Since we know our total contribution, don't forget that we're working on inpatient days. Since we know our total contribution, where did I solve that? I can explain. Okay. Hold on, let me see where it was solved. Okay, this is it. So cost per day. Since we know our contribution margin. So what's our total contribution? Our total contribution is what? 234,000, because sales minus variable cost is contribution. So we have 234,000. Okay, I hope you are following. Then we will now divide it by what is the inpatient days in the question? Inpatient days, 26,000. That's what we now divide by 26,000. That is how we got this 9 naira you are seeing here. So this contribution per unit is simply contribution, which is a total contribution of 234,000, where we say sales minus variable cost. Then we now divided it by what? We now divided it by inpatient days. Normally, if you want to get contribution, we would have said total contribution divided by quantity. It is this quantity now that is that inpatient days that we saw in this question as 26,000 per annum. That's what we are going to put there as 26,000. When you divide, you get 9 naira. So if you divide these two figures, you're going to get 28,000 days. This is our break-even point in inpatient days. Okay, so 28,000 days. The number of time, the days that patients spend in our hospital. Okay, the number of days that patients spend in our hospital. That is our break-even point in patient days, 28,000 days. That is where we break even. All right, that is when we break even. So let me just do a quick recap on that. We are solving for break-even point in inpatient days. So I said view this inpatient days as quantity. That is why the formula is what? Total fees cost divided by contribution per unit, because for quantity, you make it a contribution per unit. So what's our fees cost? It does not add 252,200. This is it here. Then what is our contribution per unit? We don't know what contribution per unit is, but we know how to get contribution. Okay? They did not give us contribution per unit expressly, but we know that our sales is 1.3 million. Okay, 1.3 million. And we know that our variable cost is 1,066,000. So sales per variable cost will give us contribution of 234,000, which is this year. So that's 1.3 minus 1,066,000. 234,000. This is total contribution, but we're looking for contribution per unit or per inpatient days. So this 234,000 divided by the inpatient days in the question, 26,000 per annum. That will not give us the per units or per day, which is 28,000 days. Do you understand? It's 28,000 days. No, which will now give us 9. Okay, 9 naira. If you do this divided by this, will give us 9. Then 252, which is our total fixed cost. Okay, total fixed cost divided by our contribution per unit, which is 9 naira. That will now give us 28,000 days. I hope this makes sense. Okay, so if that is fine, for our inpatient days, what's the next thing we're looking at? We're looking at III, the margin of safety ratio, if the clinic operates at full capacity. The margin of safety ratio, if the clinic operates at full capacity. Let's go to margin of safety. One with margin of safety. So this is margin of safety ratio. What is the formula? The formula for margin of safety ratio in units is simply margin of safety itself divided by budgeted sales, okay, in units. Both of them are in units. How do we get this margin of safety? We said budgeted units, Abi, because we're looking at units, minus break even in units. Okay, so all over this budgeted sales is still budgeted what? Sales in units. So this is the formula. So once you understand this, okay, the formula for margin of safety ratio is simply margin of safety, whether in units or in naira, divided by budgeted sales in units or the budgeted sales in naira. We can now come back and say, okay, the margin of safety ratio, if the clinic operates at full capacity, will now be what? The budgeted what? The budgeted what? Capacity minus break even, which is BEP, okay? Break even capacity. All over what? Budgeted what? Capacity. I think that is what they should have done. So budgeted capacity minus break even capacity divided by budgeted capacity. So this is it. Good. Good. So that budgeted capacity is what they are calling full capacity here. So don't forget we are calculating for inpatient days. So budgeted capacity for inpatient days minus break even in inpatient days divided by the same budgeted capacity inpatient day, which is now the full capacity. Okay. We already know break even capacity in inpatient days. We already know break even in inpatient days. We've calculated it here as 28,000 days, which we put here as 28,000. But the only thing I would not know is our full capacity. What is full capacity? It means if the company or if the hospital runs at full capacity, that is to say, they use all their beds, people come in full time for 365 days. So if they use all their beds, remember that they have 80 beds in a day in the question, and they use this 80 beds in a day for 365 days, their full capacity is going to be 29,200 inpatient days. Let's go up, let me show you. Their inpatient days is 26,000 per annum. Okay, that means that they did not use to full capacity. Because if they wanted to use to full capacity, the number of days the number of beds that are available on a daily basis is 80. And all things meaning for we have 365 days. If you multiply 365 by 80, they're supposed to use about 29,000 plus. But what they only used was just 26,000. Okay, 26,000 days. So let's go on. So at full capacity, you make use of 80 beds times 365 days, which is giving us 29,200 inpatient days. That's how we have this 29,200 here and 29,200 here, full capacity. So that is budgeted. That is what they are meant to achieve on budget basis, based on what they have. That's what they are meant to achieve. So 29,200 as budgeted capacity, inpatient days, minus BEP inpatient days, which is 28,000 that were completed, divided by budgeted capacity inpatient days times 100%. That will give us, if we solve the mathematics, that will give us 4.11%. I hope we are getting this. So it is the same thing with our manufacturing, just that names changes, okay? The names, the way we compute for service changes. Look at, we are looking at inpatient days. Manufacturing, I'll be looking at quantity, kgs, units, something like that. All right, so let's go to the next one. What do you want us to calculate again? Is that all? Okay, IV. They want us to compute IV. They want us to compute the break-even points in inpatient days if direct salaries were increased to 826,000. They want us to calculate break-even points in inpatient days if direct salary. Where is direct salary? This is it. It was formerly 800,000. And we are told that if we now increase 800,000 to 826,000, making our total variable cost to be 1,092,000. Yes, which is clear. If we take out this 800,000 and replace it with 826,000, which is this, if we add all the figures down, what we should be having now is 1,092,000 instead of 1,066,000. All matters not specified remaining the same. And so the only thing that is changing under IV is change your direct salaries to 826,000 from 800,000. That's the thing that is changing. So what we just need to do is to say, remember what we want to calculate is break-even points in inpatient days. And this inpatient days is like quantity. So the formula that we need is fixed cost divided by what? Contribution per unit. So what is our new contribution? Our new contribution is what? 1,092,000. Okay, and we're calculating it for inpatient days. What is inpatient days? 26,000 to get per unit. So 1,092,000 divided by 26,000, that will give us contribution per unit. Then our fixed cost is remaining the same, 252,000. Let's confirm that is what they did though. Let's confirm that's what they did. Break-even points inpatient days, good. Okay, our total fixed cost changed. Did they tell us anything about fixed cost? Fixed costs. It doesn't, the break-even points. Okay, break-even points in inpatient days if fixed costs made. Okay, we are solving IV. We have a solution for IV. Okay, this is IV. This is IV here. So total fixed cost is 252, as I've said, 252,000, as you see in the question. Is not hiding 252,000. Then what we now focus on is what? Contribution. And our contribution has increased from 1,066 to what? 1,092. So you're going to say 1,092,000 divided by what's per unit? What's per unit? 26,000 per annum. Okay, I think that's what we are supposed to do. Good, good, good. So good. So 10, do it for me, you get 8 naira. Let's do it. Let's do it. 1,092,000, which is this new variable cost. Is the new variable cost. 1,092,000 divided by 26,000 to get variable cost per unit. So 1,092,000 divided by 26,000 to get variable cost per unit. And our selling price was what? What was our selling price? 1.3. 1.3 was our selling price. 1.3 divided by 26,000. We have 42 first. 42. Let's confirm if we are correct. 42. How do I get by 42? 1,092 divided by 26 to give me variable cost per unit. Then what about sales per unit? Sales per unit is simply 1.3 divided by 26. That's my mathematics, so in my head. Divided by 26,000. Oh, that gave us 50. That's our sales. So our sales per unit divided by variable cost per unit is equals to 8. Okay, all this is clear. 8. That is how we got this 8 that you are seeing here. Working 3. There are workings there, but I'm just doing my own. That's how we got this 8. So this is the workings. So sales minus variable cost divided by the quantity, which is at 26,000. You solve the mass, you get 8 naira. Okay, you get 8 naira, which is 8 naira here. I hope this is fine. I hope this is very clear. So 252,000 divided by 8 naira is what is giving me 31,500 days as my break-even in quantity or in inpatient days. Okay, then the final one asks us to calculate our break-even point in inpatient days if fixed cost changed. Let's go and check. So our break-even points, the break-even point in inpatient days, if fixed patient service overhead will increase to 120,000. Okay, making total fixed cost. Where do we have fixed patient service overhead? This is it, patient service overhead from 102. It will be increased to 120,000, making our total fixed cost to be 270,000. So if you replace this one with 120K, what you should be having is actually 270 total. So our fixed cost has changed to 270. That's the only thing that will change. So let's go to our solution. What do we have? What do we have? What do we have? Total fixed cost has changed to 270, but our contribution per unit is 9 naira. I think we solved it somewhere before, which is this. Okay, contribution per unit is 9 naira. This one, 9 naira. Please don't use this 8 naira because V does not rely on IV. Okay, V must rely back to the original question, to the original one, and that original one was this 9 naira that we got. So don't want to use 8 naira as your contribution per unit. This 8 naira was just based on IV only. Okay, so you must use the original data that you have to compute for any other subsequent ones. That's why our contribution per unit, contribution margin per unit is 9 naira as against this 8 naira. Okay, as against this 8 naira. Any question on that? Any question on that? Any question on that, please? Now, the last part of what we'll be looking at under CVPA is multi-product break-even analysis. In fact, this is what is basically obtainable most times in practice, because you hardly see an organization now that is just offering one service or that is only selling one product. So what we are trying to say is that when an organization has more than one product, that means they have a list of product line, okay, you would need to apply the principles that governs multi-product break-even analysis. This is quite very simple. The major thing that I will just let you know is the steps in answering or in attempting a question like this and some points that you just need to know. Okay, so from here to perform break-even analysis in multi-product organization, however, a constant product sales mix must be assumed and all products must have the same CS ratio. Okay, so we're going to explain what this means, but let's come down to this. So what I want to point out is that all those formulas that you have seen initially that you see divided by contribution per unit, now that it's a group of products, okay, it is not going to be weighted contribution. So weighted contribution simply means when you have factored in the contribution of every product in your product line, you look for the weighted average for it. You look for the weights of those things, like the weighted average. You know, accountants will make use of weighted average when we have lists of options or list of figures. We just look for the average of it, just like saying opening inventory plus closing inventory divided by 2. So under CVPA, if you have list of products, we're going to calculate the contribution for each of those products. But since we are calculating the CVPA for all products at once, we are going to look for the weighted average of all the contribution for the products in the product line. So these are basically what you should understand. Then these are the steps involved. Calculate the contribution per unit of each product, which I just said. Then compute the contribution per mix. Mix, okay, mix talks about, you know, a suitable combination of each product. You know, when we are doing limiting factor, you will hear me say, what is the sales mix that the company should adopt? Because the company is making like 3 products. Do you think that the company should sell 100 pieces of product A, 70 pieces of product B, and just 40 pieces of product C? That's what I mean by sales mix. It's a combination, a strategic combination of quantity to sell. So yeah, if you are saying compute the contribution per mix, the mix there is the whole product line that we have looked at. Okay, that's the mix. So we're going to calculate the contribution for that mix. So if product A, B, C, and D forms part of a mix, we'll compute the contribution for that mix rather than just calculating the contribution for just the product in the mix. So for example, if you have product A, B, and C, these are individual products. What we have been doing before is that we are going to calculate contribution per unit for each of these products. But now the company wants to see the whole product performing as one, conglomerate as one. That's the mix, okay? So that is why we are going to calculate contribution for each of them. Then the next thing that we are now going to do is to look for the weighted average of all of them. And all of them together is what we mean by the mix. All right? So that's what the weighted average of all of them. Then, before you can now move towards calculating the break-even point in terms of number of mixes, then break-even point in terms of number of units, and calculate the break-even point in terms of revenue, in case based on what the question asks you to compute. So, but the major thing that you just need to understand is calculate the contribution for each product, then look for the weighted average. Point number 2 and 3, which is very important, you can jot this one down, is when you are computing for break-even points in units, you make use of weighted average contribution, weighted contribution margin, WCM. Okay, but when you are calculating for break-even points in Naira, you make use of weighted contribution margin ratio. So for weighted contribution margin, you make use of units for your computation. It's just normal thing. You know, this unit before is just contribution margin. Is this weighted that we are adding to it? Weighted means we are factored in the 3 products. We are just looking for the weights, the average. In simple terms, the weights there is the average. Okay. Then, if I'm calculating for BP in Naira, you know, we usually use contribution margin ratio. Just add weight to it. It's as simple as that. These are the 2 basic points. Every other thing is simple. So let's look at Ekitikete and see what this one tells us about. It's an ICAN adapted question. So what they gave us in this question is that they said Ekitikete Industries Limited manufactures 2 products, rice flour and beans flour. Now the following data are projected for the coming year. This is for rice and this is for flour. So this is the kg you will sell. This is the Naira amount. Kg you will sell. This is the Naira amount. So if this is what you will sell and this is the Naira amount, then 100 divided by 100 is what? Per unit selling price. Does that make sense? This one, 200 divided by 80 is per unit selling price for bean flour. Then we have fixed cost of 20,000. We have variable cost of 60,000. We have total cost, which is 60 plus 20, which is giving me 80,000. And our profit is what? 20,000, which is 100 minus 80, which is 20,000. Now look at the whole requirement that they put before us. ICAN and their wahala. Then I said, you are required to compute the break-even sales in kilogram for rice flour. Focus on rice now. The break-even sales in kilogram. That kilogram now is more or less saying in units. You understand? In unit. For rice flour, assuming that the facilities are not used jointly. Okay? Assuming that the facilities are not used jointly. So calculate the BEP for just rice only. Forget about joint products. Forget about using beans together with rice and you're not going to calculate the weighted average. No. I can say calculate just for rice only. So just for rice only, what is the break-even point in units? It is simply fixed cost, divided by what? Contribution per unit. So what is fixed cost in this question? It is 20,000. What is contribution per unit? Our sales is 100. Our variable cost is 60, which gives us 40. Then 40,000 divided by 100,000 will not give us contribution per unit. Let me come back. Okay, let me come back. Our fixed cost is already 20,000. It's in the question. Then our contribution per unit, contribution is simply sales minus variable costs. Okay, but they give us total sales. What's total sales? 100,000. 100,000. What's our variable cost? Our variable cost is 60,000. It's total, not even per unit, total. But no problem, we have to convert to units. So once you minus, you have what? Variable cost, total variable cost of 40,000. So you have to divide it by the quantity that you produce, is 100,000. So I think if you do this, you should be able to get, is it 0.4? You get 0.4 as your, what do you call it? Contribution per unit. That's 0.4. So this 20,000 will not be, here will not be 0.4. So if you do 20,000 divided by 0.4, you should be having 50,000. Okay, our answer here is 50,000. That's our break-even point in unit, that is in kilogram, for just rice flour, assuming that rice flour and bean flour are not sharing the same facility for production. All right, let's confirm our figures. Good, 50,000 kgs. So 20,000 divided by 0.4, and I'll show you how I got my 0.4. Okay, sales in total minus variable cost in total gives me 40,000. 40,000 divided by quantity that I produce, that will give me 0.4. Okay, 0.4. I hope this makes sense, sir. You can always communicate with me, please, so I will know that I am still with you and you are still with me. So let's proceed. So the ICAN says break-even sales in Naira. So this one is not in value for bean flour, assuming that the facility are not used jointly. So we are going to calculate for bean flour, assuming that we are not using the same facility to produce both of them. If we are using, we are going to use weighted average. But now, no need for weighted average idea. So let's use bean flour. So what do we do now? Our fixed cost for bean flour is how much? 56,000. So let's see, we have 56,000. So let's get our contribution per unit. Contribution per unit here, 0.7. How did they get 0.7? So contribution per unit is simply sales minus variable cost. What is the sales here? 100K. 100,000. What is the variable cost here? Variable cost is 30,000. Okay, 30,000. 30,000. So our total contribution is 70,000. But this is total. We have to divide it by quantity here, 80,000. I think that's how we got 0.7. I mean, 0.7. 0.7. And that gives us 80,000 naira. Okay? That gives us 80,000 naira. Okay, so 70 divided by 80. Divided by 80. And it was 0.875. 0.8. This is 0.875. Okay, 0.875. Then okay, 100 minus 30 is 70. 70. That's total contribution. Total contribution divided by 80,000. 70 divided by 80. I hope you are following me. I'm not the only one doing mathematics here. Okay. So I think that's how we got this 0.7 here. So our break-even point in sales is actually 80,000 naira, correct? Okay, let's proceed. This one is offer. Is Sarah in your question. Let's move to the main. Now, the now told us that I. Composite quantity, from that word, composite, joints, okay? They are two goes together now. So composite quantity, contribution margin. Composite quantity, contribution margin. Assuming that consumers purchase composite quantity of 60 kilograms. Okay? So composite quantity, contribution margin, assuming that consumer purchase composite quantity of 60 kilograms of rice flour and 40 kilograms of bean flour. I will show you something that you need to know here. Once you know it is over. Okay, once you know it is what? It's over. Now, this one now we are going to apply that weighted average. But watch. They told us that if you calculate the composite quantity contribution margin per unit, quantity per unit, assuming that consumers purchase composite quantity of 60 kilograms, see, this is units, and 40 kilogram of bean, this is units. So this unit has made me understand that what they want me to calculate here is more or less saying like break-even point in units. Okay, but what we are calculating here is contribution margin in units. Okay, contribution margin in units, not contribution margin ratio. If it was ratio, they would have given us the figure in more or less like told us in more or less like ratio. Like this one, a composite contribution margin ratio. This one, we know we are using value to compute it. This one, we know we are using units to compute it. So this is more like the unit part. This is more like the naira part. This is the unit part. This is more like the naira part. Okay. So composite quantity contribution margin, assuming that consumers purchase composite quantity of 60 kilograms of rice flour and 40 kilograms of bean flour. Okay, so this is the combination. This is the combination. So we are going to produce, we are going to sell, or consumers are going to purchase from us how many units? 60 kilogram of rice flour, and they're going to purchase 40 kilograms of bean flour from us. So 60 plus 40 is equals to 100. So let's just see what we are going to do. Normally, I told you calculate your contribution per unit first. So this is rice flour, and this is what? Bean flour. Remember that what we want to calculate is contribution margin per unit. Let's confirm. Composite quantity contribution margin is it per unit. So for you to calculate contribution margin per unit or contribution per unit, that's the same thing. Contribution per unit or contribution margin per unit. You need to get contribution first. Okay, you need to get contribution first. That is why we are calculating contribution first. So our selling price is this per unit and our variable cost is this per unit. How do we get our selling price? We've done it before. If you sold 100,000 naira and you also sold 100,000 kg, our selling price is 100 divided by 100, which is 1. For beans, it is 100 divided by 80,000, which is what? 1.25. You can punch that. 100 divided by 80,000. 1.25, correct. These are selling price per unit. And this is the total. We need it. Then the variable cost per unit, we've done it before. Okay, we've done it before, 0.6 and 0.375. Let's confirm. Variable cost per unit. How much is our variable cost? Yes, 60. Okay, 60 divided by 100 is what? 60 divided by 100, that should be 0.6. That's how we got variable cost here, 0.6. And the other one is variable cost for beans. What's the variable cost here? 30. 30 divided by 80. So you can punch that. 30. Variable cost is 30 divided by 80 total quantity. That gives us 0.375. And that's how we got this figure here. So sales minus variable cost equals to contribution. Contribution. Does that make sense? Contribution. And total contribution is 1.275. Now we need to get our sales mix. This is sales mix. So sales mix. What's the sales mix? They told us that in the question, we are told that 60 kilograms of rice and 40 kilograms of beans. So it is 60 kilograms of rice and 40 kilograms of beans that is giving us this, that we are going to calculate now on this unit contribution. Okay, so this is per unit contribution that we are going to get. That is per unit profit we are going to get if you sell 1 unit. When you sell 1 unit of a product, this is the profit you are going to get, 0.4. That is contribution anyways. If you sell 1 unit of beans, that is 1 cup or kilogram of beans, you're going to get 0.875. So we are going to do 60% of this 0.4 and 40% of this 0.875. Okay, 60% of 0.4 and 40% of 0.75. Now let us do it this way. I want you to understand it this way because of practice. If you tell your boss that, sir, if you sell 1 cup of beans, we are making a contribution of 0.40. Your boss will now say, okay, multiply by how many cup of beans do you think that we are going to sell in a month? We know that we are supposed to be able to sell 5,200 cup of kilogram of beans, of rice, whatever. So we'll do 5,200 multiplied by 0.40. That will give us about 2,080. For example, this will now be our total contribution. But don't forget, it is 60% of this that we need. Because we are only, this is what we are supposed to make. But we are only, our beans, we did not finish selling all these 5,200. We only sold 60%, take it that way. So that means that we are not going to realize the whole 2,080 cost, total contribution. We are only going to realize 60% of this amount. That is why they told us in the question that, assuming that customers, okay, assuming that customer purchase composite quantity of 60 kilograms of rice flour and 40 kilograms of bean flour. So just assume that from this, our unit contribution, we are only getting 60% for rice, and we are, from this, our unit contribution for beans, we're only getting what? 40% for beans. That's what I'm trying to say, all right? Okay. So we're going to say 60% of 0.4 and 40% of 0.875. That's what we did here. 60% of 0.4, 40% of 0.875. Anyhow you want to do your mathematics, but just calculate it that way. Okay, so I can just put their 0.4% and 0.60% and put their 2 nairas separately again. So you multiply and you add it together. Once you add it together, you're supposed to get 0.59. So it is this 0.59 that is our composite quantity contribution margin. I hope I'm communicating, please. So let's go back again and take a tour. Let's go back again and take a tour. Let's go back again and take a tour. We want to look at we want to calculate our contribution margin for the 2 products. In simple terms, we want to calculate our contribution for the 2 products. Okay? And what's the formula for contribution? Sales minus variable cost. This is supposed to be our answer for per unit. If we add together, this is supposed to be our answer is 1.275. But we were told that we are going to, the mix of sales is this. 60% belongs to rice, while 40% belongs to what? Beans. So we're going to 60% of the rice and 40% of the beans. So the two answers, we add it together because we're looking at composite, the two products together, and that will now give us a contribution margin per unit. That's what we just did here, 0.59. So I hope I'm communicating. So let's look at the next one. We'll see some other questions so you get more, you understand more. Most cases, this 0.5, this 60% and 40% may not be given to you. We have a way of getting it if it is not given to us. So we're going to solve an ICAN question that will show. We're going to solve an ICAN question that will show how we get it. Let's solve for this other one. Then we can now recap all together. Now, they now told us that for IV, now say determine the break-even quantity of both products. You see it now? For the both products now, determine the break-even quantity of both products, assuming that consumers purchase composites 60 kilogram of rice flour and 40 kilogram of beans flour. Okay, so if you are buying, there's to buy 60 kilogram of rice and 40 kilogram of beans. Let's take it that way. Okay, that is the combination they usually buy. So we want to calculate the break-even quantity, which is break-even point in units. Normally, what we're supposed to just do to say fixed costs, divide it by what? Contribution per unit, because we're solving for quantity. Okay, there would have been no need for this 60%, which is 60 kilogram, and 40%, which is 40 kilogram. So let's go and apply this formula now and solve. So if we are solving this break-even quantity in units for two products, I told you that this your contribution per unit will not turn to what? Weighted contribution per unit. Abi? Weighted contribution per unit. So let's go on. Let's solve. Our break-even point for both products will now be 76,000. 76,000 is our fixed cost. Okay? 76,000 is our fixed cost. How do I know? Let's go back to the question. Do we have it there? Our fixed cost. Yes, 20,000 plus 56,000. That'll give us 76,000. That's our fixed cost. So I've gotten 76,000 here. Okay, good. What about our contribution per unit? It is our contribution per unit that they are calling contribution margin here that we solved. So contribution per unit simply means what? Sales minus variable cost, which give us contribution per unit. We are supposed to stop here, all things being equal. But you cannot stop here because it is two products. It is two products, and ICAN has given you the portion of sharing. Then I told you that apply 60% for rice and apply 40% for beans. So do 60% of 0.4, the answer that you get. Do 40% of 0.875, the answer that you get. Add it together. That will be our contribution per unit for both products. That's what I'm trying to explain. Okay, that will be your contribution per unit for both products. No rocket science about it. So this part that they told us, composite quantity contribution margin, simply means contribution per unit. But since it is for both products, we must give them a sharing pattern, which is this 60 and 40. And that is why when we got our contribution per unit by saying sales price minus variable cost, we now must say, okay, right, so 60% is what we are looking for. So 60% of 0.4, we take it out. Then being so 40% of 0.875. That is where we now combined it here. That's how we got 0.59. Okay, that's how we got 0.59. Please, I hope this is clear. I hope this is clear. So this 0.59 that we are putting here. Remember that this formula is fixed cost divided by contribution per unit. So this is how you get your contribution per unit. Now all these things that we have been solving here is our contribution per unit. Contribution per unit. That's what we did. 0.59. That's how we got this 0.59. So that if you divide the fixed cost divided by contribution per unit, what you are getting is 128,814 kgs. So this is what you are going to produce or whatever you are going to sell for it to break even. Okay, you're going to sell for you to break even. So let's share it. This 1.28 belongs to both products. Okay, so don't forget that rice is taking 60% and beans is collecting 40%. That means that we are going to sell 71,288 kgs of rice, and we're going to sell 51,562 kgs of beans. But that is their proportion of sales. That is their sales mix. That is their sales mix. Okay, that is their sales mix. What we computed here, sales mix. This of this, this of this. Okay, please, is this clear? Are you getting it? Are you getting it? All right, so thank you. So let's proceed. We've calculated your break-even point in units. That is for both products, break-even point in units. Let's see the next requirements. VI, break even in Naira, assuming that rice flour and beans flour become 1 kilogram complement, that there is no change in company's cost. It's grammar. Yes, it's grammar. Yes. And the only way you can understand this grammar is when you keep solving questions. So if you have never solved this kind of question before, there is no rocket science. You will not be able to solve it. Because first of all, the grammar is not even clear. Determine the break-even sales in Naira, which we already understand that this is break-even sales in Naira. Then I said that assuming that rice flour and beans flour become 1 kilogram complement. So we're only looking at 1 kilogram. Okay, we are not looking at 60 kilogram and 40 kilogram again. We are looking at 1 kilogram. Okay, that's what they're trying to tell us. And there is no change in the company's cost. No other cost is changing. Variable cost is not changing, fixed cost is not changing, every other thing is the same. So what they just want you to calculate is calculate the break-even point in Naira. But this time, don't do 60%, don't do 40%, use 1 kilogram. Okay, that's what we want to do. So that one is very simple, straight ahead. So this is it here, break-even point in Naira. Our fixed cost, they say cost will not change, which is 76,000. So cost is not affected. But we have, okay, we have to solve V. Have we solved this? We have 0.57. Have we solved V? Let's check, sorry. V. Composite contribution margin ratio, assuming that the composite demand is defined as one. Oh, we've not solved V. So V will give rise to this one. So composite contribution margin ratio, are you saying a CM ratio, composite for the two products? Assuming that a composite quantity is defined as 1 kilogram of rice flour and 1 kilogram of beans flour, they must always give you the mix. Okay, they must always give you the mix. Where the mix is not given to you, I will show you how to get the mix. I can't test it in November 2022. They did not give us mix. We confirm we got the mix by ourselves. Okay, so in this question, they are lenient. They give us the mix. They tell us that 1 kilogram of rice goes for also 1 kilogram of beans. So, for example, if a customer is coming to buy, is buying 1 kilogram of rice and 1 kilogram of what? Beans. Okay, that is the two together is what we're going to combine to produce our contribution on the sales. All right. So, what's the formula for contribution margin ratio? We're trying to say cost. Contribution divided by sales. Okay. Contribution divided by sales. That's the formula for contribution margin ratio. That's what we're trying to calculate here. Composite contribution margin ratio. So contribution divided by sales. So that's the formula that they applied here. Yeah. So I think this is contribution and this is sales per unit. Okay, per kilogram. Per kilogram. So what is our contribution per kilogram? The same thing as saying per unit. And what is our sales per unit or per kilogram? That's what they're trying to tell us. So just go back to this, your workings. You have done it before. This is sales per kilogram per kilogram. Combined is 2250. Come and check it. 2250 sales, 2250. What's your contribution per kilogram? Come and check it. Just like saying contribution per unit, you understand? So when you calculate the contribution for rice, you got 0.6. When you calculate contribution for beans, you got 0.375. Add it together, you got what? 0.975. That's what we pick. Okay, no. That one is variable cost. This is contribution, please. Contribution is what? 0.40 here and 0.875 here. If you add it together, you get 1.275 per kilogram. Per kilogram. Okay? That's how you got 1.275 here. Divide. That's how we got 0.57. Are you seeing it? So you must be very careful. For 2 kilograms, you can multiply. For 3 kilograms, okay? Apart from the standard one that they gave to us by the telling us that is 60-40. All right? So you have to be careful of the kilogram. You have to be careful of the sales mix. It's the sales mix that will assist us to do our computation very well, in as much as there are more than one product. Do you understand? Yes. So the final one is VI. VI now says calculate our break-even sales in Naira. So since we have gotten our CM ratio, CM ratio, which is our CS ratio, calculating break-even sales in Naira is not hard because the formula for break-even sales in Naira is simply saying fixed cost divided by contribution to sales ratio. And we have already calculated our contribution to sales ratio on the assumption of what? 1 kilogram of beans and 1 kilogram of rice, which is the same thing with this assumption on that V. 1 kilogram of beans and 1 kilogram of rice. Okay? That's it. So let's just go there and solve it. So our fixed cost is 76,000. Then our CM ratio is what? 0.57. And when you divide, you get 113,333. So this is how far, okay? This question can push us to the wall. This is how far it can push us to the wall. Just understand that you need to calculate contribution per unit of your product. You need to now put it into their sales mix. That is to say, apply the ratio that the question gave to you. If the question is changing ratios continually, you should be changing, be applying those ratios on that actual contribution that we made, okay? On that actual contribution that we have completed. And if you check, our contribution here is in Naira, okay? They are in Nairas, the contribution per unit, all right? So I believe this is clear. I believe if you also practice it again, you should be able to understand whatever that we have done here. So this is ICAN question 5, which we are going to be looking at now. Okay. So we have this question from November 2022, I think, from May 2022, I think. So this is question 5 and on Abayomi PLC. Now, if you look at this question, what they say, very short question anyway. And we have about 3 requirements for 15 marks. 5, 5, 4, okay, 6, 5, 4. So we are told to determine, okay, the break-even sales in units for each of the products using the budgeted data. Okay, we are told to determine the break-even sales in units for the products using the budgeted data. So first and foremost, break-even sales in unit is simply fixed cost divided by contribution per unit. So if I read this data, I'll try to look for fixed cost and contribution per unit. So let's go. Abayomi PLC produces and sells 2 major products, A and B. The budgeted income statement for the year to December 31st, 2022 is given below. So we are giving sales in thousands, in millions. Okay, this is sales value. Then production cost comprised of material, direct labor, variable overhead. Then we have fixed overhead. And these are total costs, which is the addition of all these costs. And our gross profit is sales minus total cost, which gives us gross profit. They now deducted fixed selling and admin expenses of 8.3, which now give us a net profit of 7.9 million. Now, they now came down and said that the budgeted selling price of the products are 120 and 180 for product A and B. You are required to determine the break-even sales in units for each of the products using the data below. So because the data above, okay, comprised of 2 products, that means that the break-even in unit that we want to compute is going to be multi-product break-even. All right. That means this contribution per unit will not be what? Weighted contribution per unit. So what's our fixed cost? That's the first thing you need to ask yourself. What's your fixed cost in the question? What's your fixed cost in the question? I think I have one fixed cost here, 2240, and I have another fixed cost here, 8320. These are the major fixed costs I have. So you can do 2240. Please, let's put this one together. If you don't understand this one, it will be difficult for us to understand the other one. 320. So what do we have? I think we have 10,560. 10,560. 10,560, yeah. So let's see if that's what they got in their own solution. Where are you? Fixed cost. Where are you? Good, 10,560. This is the working that they did for it. 10,560. Thank you. So what's the next thing that we need to compute? I'm not looking at their solution now, but their solution is good, okay? But let us just create a way at which we are able to understand it. So the next thing, okay, this is the formula here. The next thing is what? Weighted contribution, WC. Weighted contribution. So for us to solve for weighted contribution, you know, okay? You know that we are supposed to calculate contribution first before we now weight it, okay? That weighting is that sales mix. We apply that sales mix to weight it, all right? So let's calculate contribution first. We'll now apply that sales mix if they give us 60, 40%. But if you check the question, they did not give us anything relating to percentage. 40, 30, 70, they did not give us any combination. So we have to get our combination by ourselves and apply it on the contribution to get our what do you call it? Our weighted amount. So let's calculate contribution. Let's calculate contribution first. So did they do that? If they did that, okay, yes, they should have done that. This is it here. This is it here, contribution. Don't forget that the formula for contribution is sales minus variable cost. Okay? Sales minus variable cost. Now, what is our sales? Sales was given to us in the question directly. 120, 180. Just pick it, Ctrl C, Ctrl V. This is it. 120, 180. What about our variable cost per unit? What we need to do for our variable cost is to go up. We have several variable costs. We have material, labor, and variable overhead. Please add these three. That will give us our total variable cost. Okay, this will give us our total variable cost. Let's add them up. 2240 plus 1120 plus 1120. That should give us 4480. Thank you, 4480. That's our total variable cost. So total variable cost is equals to 4480. So normally we're supposed to say divided by quantity now to get variable cost per unit. You understand? But what is the quantity? Quantity was not given to us. But since we know sales in total, 8.4 million, and we know sales per unit, 120, that's what we have already gotten quantity already. You understand? So 8.4 million or 8,400 or 8.4 million divided by 120. That means our quantity for product A is 70,000. Okay, 70,000. So let's put 70,000 here. But you're going to do 4480 divided by 70 because this 30, there's supposed to be 30 here. So you can either put it in full. 4480 divided by 70. 4480 divided by 70. That will give us how much? 64. So 64 is our, even if you do 4480,000 divided by 70,000, you get 64. So 64 is our variable cost per unit. Let's go and confirm. Let's go and confirm 64. I hope you are getting it, sir. I hope you are getting it. So that is what they did here. This is their own. This is their own computation. They did 8.4 total divided by 120. Now this is their units. So 25.2 divided by 180. This is their own 140,000. So let's do for B ourselves without looking at their own. So we sold 25.2 million. So we're going to divide it by 180 to get our units. How much is that? 25.2 million divided by 180. That will give us 140. 140. That'll give us 140. Good. This is it here. 140,000. Okay. So that's the quantity. So the variable cost per unit will now be how much? We have to add all these variable costs now. All these variable costs and divide it by 140,000. So all the variable costs that we incur for the period plus 2240. What do we have? We have 10,640. So divide it by 140,000. That's 140. Just say 140 because the 1,000 is up. 76. I'm getting 76. I'm getting 76. Yes, 10,640 divided by that will give you 76. Here is their solution. 76, correct. I hope you're on the same page. I hope you're on the same page. So we got 76. So simple, we have through. So selling price minus variable cost is equals to contribution. Okay, it's equals to contribution. So our total contribution will now be 56 plus 104. 56 plus 104. That is 160. 160. Now, how do we get this weight? How do we get this weight? If we are told in the question that, product A, the contribution is 60, product B is 40, or one is 25, the other one is 75, it's simple max. Just come and put the one. If A is 25, put 25 under. If B is 75, put 75 under. Okay, put 75 under. It's simple math, just like the one that we did earlier. But since they did not tell us anything relating to that, okay, and what we are trying to compute, what are we trying to compute? We're trying to compute the break-even sales in units, okay? That is very important. If they say in value, it's different. So in units, that is to say we are going to use our units to form our weighted average. to look for the ratio that we are going to apply here and here. That is the main point. Where the sales mix is not given to you, or where the weight is not given to you, determine what you are computing. If you are computing in units, use your units to determine the weight or the ratio. If you are computing in value, use your value, sales in value, which is 8.4, 25.2 to compute for your weight. Okay, so in this case, we are computing in units. Okay, that is why I'm going to make use of this, my unit part, to compute for the ratio or my weight, which is this. How do we get this figure? Forget about how the figure was gotten. Okay, normally what they would just tell you is that, look at 70% is 1. How many 70 can you see inside of 140? It is 2. 1 plus 2 is 3. That means for product A, we have 1 over 3, which is this. But for product B, we have 1 over 2 over 3, which is this. Now, let me tell you an easy way to do it without you trying to crack your brain as to how many times one figure is appearing inside one figure. This is it. Do for product A, 70,000. 70,000. Divided by 210. Okay. Divided by 210. What do you have? That's how you get the answer. The way we used to do normal accounting, this thing now. Wait. Just divide by 210. Please, what's your answer? So what's your answer? Okay, so we did 70 divided by 210. That's how we got 0.3333. Okay, then you will do 140 divided by 210, which is this 140 divided by 210. You get 0.6666. All right. So this place that I can put 1 over 3, you put 0.333 there. That's what we computed, which is this. This part that I can put 2 over 3, you put 0.666, which is this. Okay. So those are the figures. Then multiplied by 56. Forget about this thing that they did here. Let's do our own. So multiplied by 56 for A, that's why I say 0.333 multiplied by 56. We got this figure. Then for this one, we say this one is 0.666 multiplied by 104. So if you multiply, you get 693264. Then add both together. If you add both together, you must get what I can got, 88. So our answer is what? 88. That's our contribution per unit, weighted, okay? Weighted because we combine two products together. So we just need to put into the formula. What's our fixed cost? We calculated it before as 10,560 in millions, which is this. Then our weighted contribution, which is our contribution per unit, weighted is 88. Just put it there as 88. So if you divide these two, you must get 120,000 units made up of. This 120,000 units, you will now share between product A and product B based on this percentage that we did. 0.3333 and 0.6666. So if you do 0.3333, replace this 1 over 3 with 0.3333 multiplied by this 120,000, it will give you 40,000. Then if you do 0.66666 multiplied by 120,000, it will give you 80,000. So if you add both together, it will still give you what? 120,000. I hope this is clear. So when you get your answer, you must share it to both what? Products. It's as simple as that. I hope this is clear. So this is multi-products. Okay, this is multi-product. This is very interesting. So let's go. All these ones are alternative solutions. Okay, so I don't need to touch that. The alternative way of solving it. I don't need to touch that. So I just need to solve for B. So B, we have to be very careful. Let's solve for B. So B says, let's get B. What the B says. Now look, now, assuming that the following changes are made to the budget. Where is the budget? This is the budget. Let us make some changes to the budget now. So just hold your calculator. We'll do some plus and minus. If changes are made to the budget, what is going to happen? Unit selling price of B is reduced to 160 naira. It means that our selling price for B, where is the unit selling price for B? This one, bam, cross it out. 160 is what we are making use of now. Are you seeing it? Direct material cost is expected to drop by 10% for product A and 20% for product B. So you can use your pencil somewhere. What is your direct material cost? How much was it before? Direct material, where are you? 2240. Okay, it's total, but you know, we need to work per unit because we will need to work it in per unit. The reason why I want to work in per unit is because the calculation is telling us that, the requirement is telling us that calculate how much sales revenue. Okay, calculate how much sales revenue must be earned on after tax rates of return. of 12% of the revenue. Okay, so I'm going to explain what this one means. It's something you know, but I'm going to explain it. But let's just adjust all these ones first. Direct material cost is expected to drop by 10%. So how much do we spend for direct material? Let's go back. Direct material is 2240. So let's go 2240 divided by 70. Because 70 is the quantity. Don't forget, we've calculated before 70. This is it here, 70. Pick the 70 first. Maybe 1,000. So divided by 70, that will give us how much? 32. That means our direct material will now be 32 naira. Be 32 naira. It's 32 naira. So we have to reduce it by 10%. They say to drop by 10%. So drop it by 10% by multiplying it by what? 90%. That's the meaning of reducing it. So multiply it by 90%. You get 28.8 as our direct material. I don't know if you are following, sir. 28.8 will be our direct material cost. Why? Because our direct material per unit was 2240, which is total, divided by quantity. The quantity that we've solved for before, which is 70. Okay? Once you divide it by this 70,000. So if you divide it, you're going to get 36. You're going to get 32. This 32, reduce it by 10%. That's why I multiplied by 90%. So the answer is 28.8. So we have adjusted for that. Let's still go on. That's what they're trying to tell us. They've now said that and 20% of product B. So we need to reduce direct material costs of product B by 20%. How much was it before? Before we can reduce it, we have 50-40. So 50-40 divided by the quantity. What was the quantity? 140, Abby. 140,000. So divided by 140. We got 36 too. Wow. Okay, that is 36. Okay, this is 32. This one we got 36. Direct material. 36. So multiply it by, they said 20% by, so you're going to multiply by 80. You get the current amount. So 36 times 80%. We have 28.8, the same value. 28.8. So we just need to do all our adjustment down, so we know we're just taking figures. What's the next one again? Direct labor cost for each product. So we have adjusted for selling price 160. We have adjusted for material 10. We've adjusted for material B 20%. So let's adjust for labor. They told us that direct labor cost for each product will increase by 10%. Direct labor cost for each product will increase by 10%. How much is direct labor before? 1120. Let's put it per unit and increase it by 10% per unit. 1120. Huh? So 1120. Let's convert it to per unit first. Let's work with it per unit divided by 70. That's the per unit. That's 16. So increase it by 10% times 110 divided by 100. That's 17.6. So this one is 17.6. So it's both of them. We're going to do for both of them. So let's do for this one too. 3360 divided by 140. That is the quantity to get per unit 24. Then increase it by 10%, which is times 110 divided by 100. We got 26.4. These are the new prices for them based on the adjustments. Okay, we are done with this. Next one is saying additional 456,000 will be spent on advertising. 456,000. So yes, advertising. Where are you? Where are you? Where are you? Advertising. Okay, there's nothing like advertising. So we'll spend additional 456. So advertising is a fixed cost. All right, it's a fixed cost. So we'll spend 456,000 as advertising expenses, which is this. Then 80% of total revenue will be derived from product B. This is the sales mix. Okay, this is the sales mix. So as you sell, no matter how you sell, you are getting 80% of revenue from your product B. So you are selling more of your products to what product, you are selling more of your product B than product A. So this sales mix is automatically 80% for product B and 20% for product A. You see the way I can put it? They don't tell you the one of product A. They only give you one of product B. You now begin to find what's the sales mix of product B, or do they want me to calculate the sales mix by myself, like the way we did in this first place, where we have to calculate our own sales mix or our own ratio or weights. So in this case, they've told us that 80% of revenue is for product B. That revenue is sales. So we are selling 80% of product B and we'll sell 20% of product A. Let's just put it 20:80. All right, so let's now solve. We've analyzed everything. Let's just begin to plug figures. So let's go on. So calculate how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue, assume tax rate of 40%. This thing should be looking familiar. Let's come back. Target volume to earn a target profit. Are you seeing it? Target revenue in Naira to earn a target profit. It is similar. Okay. So calculate how many sales revenue must be made to earn an after-tax. So we are going to compute the revenue that we are going to get. Okay. How much sales revenue are we going to get? Okay. Or are we going to earn? If we to get an after-tax return here is profits. So how much sales revenue must you make to earn an after-tax return of 12% of the revenue? We don't even know what the revenue is. So as they give us the revenue, it would have been easier. So 12% of the revenue, we're going to compete for that. So let me show you something before we proceed. Oh, wait, something like that here. This is the formula. Yes, this is the formula here. This is the formula we're making use of. We solved this question earlier. So let's look at the requirement of this question to compare. Okay, that's it. So look at it here. The number of units required to break even if the variable cost increases by 6%. Okay, look at it here. The number of units that must be sold to earn an after-tax profit of, they give us the profit 112,000 if the tax rate is 30%. So this requirement is similar to the one that we are looking at now. The difference is that this one, they give us the after-tax profit of 112,000. But in this our case, ICAN did not give us. ICAN just told us that calculate how much sales revenue must be made to earn an after-tax rate of return, which is the same thing as after-tax profits of 12% of revenue. That is, our profit is 12% of revenue. They didn't give us the actual profits. And assume tax rate of 40%. So we are going to apply this formula because this is the formula that we use to determine what this is the formula that we use to determine what our break-even would be, okay? Whether in units or in Naira, if we have a target profit. So this one is contribution per unit, and this one is break-even in units. Bet in units, because it's in units. Okay, at least it's contribution margin ratio that is in Naira. So what did the question want us to do? Calculate how much sales revenue. So this is supposed to be in Naira. This is supposed to be in Naira. That must be made to earn an after-tax. This is supposed to be in Naira. That is to say, we are going to make use of this formula, but we are going to make this contribution per unit is going to be contribution margin ratio. I think it's going to be contribution margin ratio. Okay, so let's apply the formula. Let's just apply the formula. So let's come down and see how they did it and just apply the formula. So this is where they solve it, but let's apply the formula here. So I'll call it, please just flow with me, fixed costs, okay? Fixed cost plus target profits over 1 minus TR, which is tax rates, okay? So when you are trying to achieve a particular profit, you are going to use this formula. Contribution margin. If it's a Naira, it will be contribution margin ratio. So let's do contribution margin ratio because they're looking for Naira. Sure you understand. So fixed cost, is fixed cost given to us in the question? Fixed cost. Yes, please, let's pick it one after the other and solve it by ourselves. I don't care whatever they have done before. Let's solve by ourselves. Fixed cost was given to us in the question as, let's go and confirm. We've done fixed cost before 10,560. 10,560, okay? 10,560. So let's bring it down here. 10, let's put it here. 10, that's our fixed cost. 560,000 plus, are you getting it? They now told us that there's an advertising cost. They told us in the information now, additional 456,000 will be spent on advertising. That one, they don't even need to tell you. Advertising is a fixed cost. It does not change. It does not change like that. Okay, so let's add it together. 456,000. I'm doing my own math on my own paper. So please, 456. What do you have? 456,000. What do you have? You can sum for me. So we have 10,560 plus 456,000. We have 11,016,000. I don't know about you, but I'm getting 11,016,000. Okay, correct. Correct. So what have we got? We have gotten fixed cost. Let's just plug it in. 11,016,000. Let me write this thing well. Hold on, please. So we have 11,016,000. Okay, it's supposed to be X here. What we are looking for. Supposed to be X there. Okay, plus, please flow with me. This is target profits. Target profits, okay? What you intend to get. But in the question, ICAN did not give us target profit. ICAN just told us that the profit is, for us to get a target profit, we're going to say 12% of the revenue. So we don't know what this revenue will be. This revenue is sales. Okay, this revenue is sales. So 12% of the sales. Okay, so we're going to do 12% of X. Just simple mathematics. 12%. 12% is how much? Just do 12 divided by 100. So not, that's 0.12. Please, just put 0.12 there. 0.12. The X is that sales I would not know. I can't eat it from us, so we need to get it. 0.12. Thank you, sir. They're divided by, 1 minus tax rate, 1 minus, our tax rate is, I think it's 40%. Maybe 40, where are you? 40%. So 40% is 0.40, I mean. 0.4, where are you? 0.4. I'm feeling it like this. We still have X here. Is equal to. So, CM ratio, contribution margin ratio. That means contribution divided by sales. So we have to calculate what contribution is, because contribution will now be what? Sales minus variable cost. So what is our sales? Remember that we have done adjustment already, so there's no rocket science. What is our sales? We have 28.8 and 28.8. No, Abi, you're on your own. No. What is our sales? This for direct material, this for labor. The sales is the same thing for 120. Okay, here is 160. So we have 120, 160. But they told us that sales should come down to 160. Check it out here. Unit selling price for product B is reduced to 160. So we have 120, 160. That's our sales. Let's go. We'll key this question. Don't worry. Sales. 120, 160. Okay, they put it down first. In your own case, you can put it up and put variable cost under it. So what about our direct material cost? We've solved for it before, 28.8 and 28.8. Let's go and confirm. We've done it. Nothing they want to tell me. 28.8 and 28.8. What about my direct labor? 17.6 and 26.4, Abi? 17.6 and let's check. 17.6 and 26.4, correct. Then the other one is variable overhead. They did not give us any additional information for that one. So we'll just pick that one the way it is. 16, I mean. So variable overhead, let's go back. We have 1120, that's total. We divide it by 70. What do we have? 70 is the quantity. Don't forget. That gave me 16. So this one is 16. So do this one. 2240 divided by 140. That's the quantity. Did we miss anything? Okay. I think we got it up to all the variable costs, isn't it? We got it up to all the variable costs, and we got it up to total variable cost. And this is sales. So sales minus total variable cost is what is giving us contribution. So since we are looking for CM ratio, don't forget CMR, because what we want to calculate is in Naira. So we're looking for CM ratio. Then our formula will now be contribution divided by sales. So the contribution that we have here is 57.6 to divided by 120. 57.6 divided by 120. You get 0.48, which is this. Then 88.8 divided by 160. You get 0.55. So this is our contribution margin ratio. 0.48 and 0.55. So let us now multiply it. So 0.48, the way we did it earlier now, 0.48 multiplied by 0.2. Please, I hope you are with me, plus 0.555 multiplied by 0.8. How do I get it? Remember our sharing. Our mix. Our mix is, where is it? Where are you? 20:80. Okay, 20:80. So 80% for product B, 20% for product A. So that's what we are trying to do here. That's the next step. So 0.4 is our CMR, will multiply it by 20%, and 0.555 multiplied by 80%. So if you do this mathematics, we must get 0.54, which is this that I got. 0.54. So it is that 0.54 that we are putting here as divided by 0.54. Are we together? Are we together, please? Okay. .54. So since we get our 0.54, let's now solve. Okay, so this is X outside. So what do we do? So punch for me, you know, board mass, and we'll treat the one inside the bracket first. I mean, something like that. So 0.12 divided by, no, 1 minus 0.6 is 0.4 is 0.6. 1 minus 0.4 should give us 0.6. So just do 0.12 divided by 0.6. That should give us 0.2. Please, you can do it to me. I'm punching my own already. 0.2 bar. Thank you. 0.2x. Okay, that x is the unknown that we are looking for too. X. So it will now be divided by 0.54. You understand? Then you bring this one here again. Plus, this will be in brackets, I mean, because of this x outside, it's equals to, like this is equals to, okay. So now that we have this one like this, what do we do? Mathematics, what do we do? Mathematics, what do we do? What do we do? Okay, so to make life easy for us, I will just rewrite this thing as 11, okay, comma 0.16, okay, plus 0.2x, then put it under here, divided by 0.54. Okay, then this my x will now be what? Equal to. So this x over 1, if I cross multiply, are you getting it now? We now have, it's mathematics we are doing now. We now have, what do we have? We now have 0. I'm coming on. Just flow with me, please. 0.54x. Because once you multiply x, we multiply this. Okay, 0.54x is equals to 11, 0.16, comma 000 plus, are you seeing it, 0.2x. Are you seeing it? I think life is easier like this now. So what I have now is to say 0.54x. This plus 0.2x will come like terms minus 0.2x. I mean, this should now give us equal to what? This amount here should stand on its own, 11,016,000. So do 0.54 minus 0.2. What do we have, please? 0.34, bar. So we have 0.34x. Thank you. Is equals to 11,016,000. Thank you. 000. Then to make x stand on its own, what do? We divide by 0.34. We divide it by 0.34. Abi, this one will cancel this one. Our x equals to what? Let's divide, please. 11,016,123 divided by the answer. Wow, 32 million. We'll check whether we are correct. 32,400,000. That's what I'm getting. Are you sure that's what you are getting? 400,000. This is my x. Let's check. Where did they solve their own? ICAN, where are you? Okay, correct. So this is that 32,400,000. Okay, so we'll now share it, Abi. So you share or you apportion. All right. So for product A, you will take what? 20% based on the question. All right. Then for product B, we take what? 80% based on the question. What we did here. 0.2, 0.8%. So multiply it to this amount. You will get 6.480 and 25,920. Ladies and gentlemen, any question on that? Confirm. All right, so that's all we did. And I think we are done with the B. Imagine, how many marks is this thing? Please, let me check. This B, how many marks? Oh, I can't. 5 marks. Okay. Let's check for C. C says that assuming all the facts in B I to V, so B I to V above, but the original budgeted revenue of 33,600. Original budgeted revenue of 33,600, which is this. Wow. Okay. The original budgeted revenue of 33,600. Compute the revised break-even sales in units for each of the products. So we want to compute our break-even sales in units. We are going to apply everything that we have done here. But this time, we are going to make use of revenue of 33,600. Remember, this is break-even sales. The break-even sales in units. So we're going to make use of the revenue of 33,600. So first and foremost, what's the formula for break-even in sales? Break-even sales in units. Fixed costs divided by what? Contribution per unit. So let's go and solve. Should not give us time. I think it's not long. Let's check. So if our total sales is 3,600, and our ratio of revenue is that A will take 20% and B will take 80%. Do come and see. Wait a minute. 6.7. Where are you? Okay. Do 20% for me. 20% of 33,600. What do you have, please? 6.72. Abi? Correct. Good. So 6.72. If you do 80% of this amount, you get 26.88. So since our sales value have changed, okay, our selling price does not change. Please note that. So 120, 160. How do I know? Because they told me that you make use of the information in I to V. And the only information in I told us that unit selling price of B is reduced to 160, but A will remain 120. So I'm using 120 and 160. So unit selling price does not change. So 120 and 160. So if that is the case, my total sales of 6.7 divided by 120, that will give me the quantity that I'm selling. You know what I want to compute is contribution margin per unit, which is contribution per unit. And contribution per unit works with what? Works with quantity. I hope you know. It works with quantity. That's why we want to determine quantity first. So there are rules to these things. Are you getting it? So contribution per unit is working with what? Quantity. That is why I want to convert my total sales back to quantity. So when they gave me total sales of 33,600, I just multiplied the percentage of sales. 20% of this revenue belongs to A, 80% of this revenue belongs to B. I bring in my selling price and I divide. Once I divide, I'll get my sales in quantity, which is 56,168,000. Does this make sense? 66,168,000. Does this make sense? Okay. Can we proceed? Okay. Let's take it again. Let's take it again. We want to calculate contribution. Let's go back to the question. We want to calculate break-even sales in units. Break-even sales in units. So since we want to calculate break-even sales in units, we are trying to get the quantity, the units that we sold. Bearing in mind that the question told us that our revenue should be 33.6 million. And we are still making use of information from I to V. And I to V, we have 80% of revenue for B and 20% for A. So we just need to share this revenue to A and B. Then what we share, we'll now divide it by the selling price per unit to get the quantity that we sold. Okay, to get the quantity that we sold. So let's come down and see what we did. So we share this 33.6 million to product A and product B using 20% and 80%. So product A total sales is 6.720, while product B total sales is 26.880. You understand? Then selling price is 120 and 160. It's in the question. If you divide these two figures, you will get quantity sold. Total sales that you make divided by sales per unit, that will give you total sales 56,000. The same thing applies to this one. Total sales of 26.8 divided by 160, that will give you 168,000 per unit, and 168,000 units sold. Does that make sense? Does that make sense? Okay. All right, so what do we do next? What do we do next? How do we get 0.25? And how do we get 0.75, which is our ratio? How do we get it? How do we get it? How do we get it? Please do 56,000 plus 168,000. What do you have? This one, the total. 224, ba? 224. So the way we did it that time now, 224. Let me show you something that we did that time. So you will remember sharp. You remember sharp. This is it, units. Remember, we have gotten unit now. So the way we did it now, 70 divided by 210. You know, we added this to get 210. Then 140 divided by 210. That's what we want to do now. Because we're trying to work with contribution per unit. We're trying to get this, all we're trying to get this 88. We're trying to get that kind of 88 here again. That is why I'm adding these two units. I work back from total back to units to get 244. So 56 divided by 244. Let's go. Now I'm getting 0.25. Thank you. Which is this? So do 168 divided by 244. You will now get what? 0.75. That's how I got this figure. So what do we do now? What do we do? What's our contribution per unit? How do we get contribution per unit? Sales minus what? What is our variable cost? This is sales. 120. What is our variable cost? Forget about the way I can solve it. You can solve your own. If I want to solve, I will solve my own the pattern I want to solve. What's my variable cost? Why am I even solving for variable cost? Because the formula is fixed cost divided by contribution per unit. So we already know fixed cost. But this contribution now we need to get sales minus variable cost. And our sales now we've computed it as 120 and 160. But this variable cost is our issue now. And our variable cost does not change. Okay? Variable cost does not change. Let's go and check for variable costs. We did variable costs before. Let's go and check. What was our variable cost when we divided? Coming on. Variable costs, total variable cost per unit, 6240 under B. Remember that we are making the information we use in B is the same information we are using in C. So 6240 and 7120. Please, let's put that in our mind. 6240 and 62.40 and 71.20. So let's go down. So what's our sales here? Our sales is 120. So 120 minus 62.40. Please, what do you get? 120 minus 62.40. What do we have? 56.6. Are we correct? Good, correct. So the other one is 160 minus. Do 160 minus 71.20. Minus 71.20, get 88.8. Thank you. Which is this? Thank you very much. All right, that's how we got this figure. Okay, so now you just need to apply the weights, Abby, to get your weight. So 57.60 multiplied by the 0.25, Abby. Our contribution multiplied by the weight or by the ratio. Then our contribution multiplied by the ratio. This will now give us our weight of 81. This 81 is what we are using here as contribution per unit. So what's our fixed cost? 11,016. This is it now. 11,016,000. Because I'm making use of information in B. Okay, 11,016,000. So 11. Just put it here. 11,016,000. So what's our contribution? What's our weighted contribution? 81. So if you divide, we have what? 136. So you have to share now. Share using your ratio 0.25 and 0.75. Okay, 0.25 of this amount, which is this, and 0.75 of this same amount. This is giving us 34,000 and 102,000 in units, which is giving us in total the same 136,000 units. Okay, so let me just do a quick review of what we just did here. In this C, we are trying to get our break-even point in units. And when we spelled out the formula, it was telling us that it was fixed cost divided by contribution per unit. Okay, it now told us that the sales value that we are going to use is 33,600. For it to give me that sales value of 33,600, it simply means that my quantity will change. Okay, my quantity is going to change. So I had to convert this, my sales in total, work back as to quantity. So how many quantity did I sell that combined gave me 33,600? That was when I applied the ratio of revenue to this to give me revenue for the two products. Then I applied my sales price according to the question and I divided and I got my actual quantity that I sold. Okay, the actual quantity that I sold. Then I applied my ratio now, 0.25 and 0.75. Okay, 0.25 and 0.75, which I said, how do we get it? 56 divided by 224. We got 0.2425. Then 168 divided by 224, you get 0.75. So don't forget that the denominator here is contribution per unit. So we have to calculate for contribution. So for us to get contribution, we'll say sales minus variable cost. Variable cost has already been solved for us. We've done it before, okay? 62.4 and 71.2 based on the B part. So we just need to bring it here and minus. So 120 divided by 62.4. So 120 sales minus 62.4 and 160 minus 71.2. That gave us this figure, 57.6 and 88.8. So the rule now, weighted now, you have to weight it. So just multiply your contribution by the ratio, that gives us 81. So that is the 81 that you see here. then your fixed cost is up. So once you divide, the answer you get, you will still share it based on the ratio 0.25 and 0.75. And that is how far this question stretched us. May I inform you that I checked the review for the question and they said the student performed below average. So many of them are not conversant with multiple CVP. So I believe that after that diet, they are preparing for it badly. So that in case it comes out again, they'll be able to do justice to it. Okay? So ladies and gentlemen, this is how far we can go for this particular topic, and I believe that we have been able to cover much. So what you just need to do is to practice more and have that understanding. Thank you very much for staying with me.